a lot out of it. And I did it again in Denver in September for the Denver Trading Group, a great group of traders, and they really liked it as well. And so I thought I would put this out to everyone else who might want to see it, because it is a pretty good presentation, I think, just in general, but a really good introduction to Wyckoff. And we're going to go through it. And as we go through the Wyckoff side of things, well, let me just go forward here a little bit before we get to that. You know the usual disclaimer here in the United States, that what we're doing here is educational information. I'm not trying to solicit any kind of buy or sell orders, and certainly can't be responsible for your trading. Just keep in mind that trading is a risky activity, and there is a very high degree of risk in trading. You always want to consult your financial advisor and your tax advisor and other advisors before making any investment or trading decisions. That being said, let's take a look at what we want to cover tonight. What I want to do first and foremost is go through the first half of Wyckoff's case study of the 1930-1931 New York Times average of 50 stocks. This was his market. They didn't have the S&P at the time. I think they had Dow. I think that was published, but he used the New York Times average of 50 stocks in this case study. And the fellow I really learned Wyckoff from, David Weiss, said to me that when he studied this, he found it kind of his quote, and I probably am misquoting him a little bit, but essentially what he said was that this had the most profound impact on his trading. And we spent a lot of time on it, and I went through and continued to study it and continue to review it even today. And I agree, it had quite a profound impact on my ability to read the market and my ability to trade. So I'll try to convey as much of that to you tonight as I can in this. And we're only going to do the first half. This is the bullish rally in what became the Great Depression bear market from 1929 into the early 30s. And probably after the first of the year, we'll do the bear market side of this, and probably maybe do it in 3 parts. We'll see. I have to look at that. I've also done a little bit of this in the VSA club for folks who might have been there. But what I would like you to recognize here or think about, and this is one of the important takeaways in all of this, is that there's a certain sequence that Wyckoff identified in a bullish market. And it's laid out here. Now you have to read between the lines, because he doesn't say, okay, we're going to go from step A to step B to step C. He doesn't do that in his write-up of the case study. But if you read between the lines and you look and you step back a little bit, what I always try to emphasize with everybody is step back, take a softer focus, and look at what the structure of the market is. What Wyckoff did for us was lay out the structure of a bullish advance or a bull market, and that's pretty nice. And so keep that in mind, that this is a sequence that occurs in virtually every rally that has any legs to it. All right. So we'll go through that, and I'll also kind of go back and forth between current markets and this 1930-1931 market and see how the same stuff shows up over and over and over again. See, what Wyckoff was really doing was, he was assessing trading behavior in the bar charts, kind of like a psychologist might look at a Rorschach test, that ink blot test that they use to identify personality characteristics and psychological problems, which I've used as a psychologist in the past lots of times too. So the analogy, not that, Wyckoff was looking for people with psychological dysfunction in the market, but what he was looking for was trading behavior in the market through price bars and volume. And that's really what he kind of identified for us. So we'll distill some of that down a little bit, and we'll look at how Wyckoff can be used today, how I pretty much use it. And we'll look at a handful of charts, and I'll show you some examples, and I'll detail what some of those examples are going to be before we get to them. And then what I want to do is I want to go through bar by bar the reading of a market. And I think you'll find that helpful. I think you'll find it useful. And we'll see some of the sequencing that occurs with Wyckoff. And then I said bonus here. It's just as I kind of decided to do this at the last minute as I was putting this together. I want to give you a trade setup that I like a lot, that I use a lot. I use it all the time, and it shows up on all the different time frames that we trade, the daily charts, the weekly charts, right down to a 5-minute chart on the intraday time frames in the S&Ps, which is what I mostly trade. So I want to show you that because it is a nice trade setup, and it's totally Wyckoff based, and you'll see how all of this comes to that point. And I think you'll be able to see this because it incorporates both structure and trade setup all in one kind of depiction of a trade. And I think you'll find it useful. It's not rocket science. I mean, you probably may even know this, but if you don't, hopefully you'll look at your own charts, your own markets that you trade, and see if you can identify this. And I would bet you dollars to donuts, as I often say to Helen, that you will be able to identify it. And the more you see it in the market take place, more you see it take place in the markets on your own charts, and then real time. Your own charts as you study them, and then real time as you're looking at the markets to trade, you'll see this, and you'll be able to see it and take those trades with some confidence. And that's what I'm hoping to accomplish with that tonight. So with that, let's get going. And as always, if there are questions, I've got this little chat window open on one of my screens. So if you have any questions, be sure to ask them, and I will do my best to address them, answer them. And as always, we don't stop until all questions are answered. And so, and by the way, no question is a dumb question or question that shouldn't be asked. You should ask if you don't know, and that's how we learn stuff. And so please don't hold back because you're not sure about the question. Please do ask the question. All right, so with that, any questions before we get going here? And will we get a copy? It'll be archived, DJ, on my website. I don't give out copies because when I do, they typically end up on these rapid share torrent downloads, and then I lose control over them. So we keep them in our archive, but you'll be able to access that. You'll have Helen will send you a link and a password to access that afterwards. But good question. And that should be up. By the way, we're going to Las Vegas tomorrow night, so she may not get it up. She's my webmaster, my wife and business partner, webmaster and taskmaster. So we may not get it up until when we get back. We're coming back on Saturday from Las Vegas. We live in the Northeast. So we may not get it back. We may not get it onto the site until the weekend. So be patient with us. All right. So let's get going here. Wyckoff in 1932, 31, I think it was, he copyrighted in 31 and then published it in 32 or 33. This was a course of instruction in what he called stock market science and technique. And it's called the Richard D. Wyckoff Method of Trading and Investing in Stocks. And it's still available from SMI. I think it's Wyckoff SMI or smiwyckoff.com. You can find it. Craig Schroeder and Gary Schuber still own that and still run it. And you can get the Wyckoff course. This is the part 1 of the course. You can get that from them. It's still available. So he wrote this course, and in the course he said the most important thing to know about the market is the trend. And since we usually aim to operate in harmony with this trend, in other words, if we're in a bullish trend, we want to be mostly taking long positions, especially if we're operating off of the daily charts and the weekly charts. If you're playing the intraday, it can be a little bit different. We can be in an uptrend like we've been, not the last few days, but since, I don't know, early September, late August. We've been in a pretty good bullish run, and yet on the intraday we can still trade short and go short, and because there'll be days when we're selling off a little bit. But for the most part, what Wyckoff was talking about at the time that he wrote this, he was really talking about the daily chart. So we want to operate in harmony with the trend. And by the way, just in general, if you are able to operate in harmony with the given trend, you probably solve 90% of your trading problems. Because when you do operate in harmony with the trend, the market can seem like it's very forgiving. When you start trying to counter trend trade, and like today we had a pretty good sell-off, right? But if you're down there trying to buy bottoms, it's the odds are good that you're going to get hurt. And today we're in a sell-off, so the best trades were going to be short trades during the course of the day. So anyway, since we aim to usually to operate in harmony with this trend, a study of our daily trend chart, which is a vertical chart of a composite stock average. He looked at the average, the stock average, like the S&P 500, the Dow 30. In his case, it was the New York Times average of 50 stocks, the NASDAQ 100, or the Russell 2000. Look at that on a daily chart, and that was his trend chart. Now, we might use a weekly chart today, or we might stick with the daily as a trend chart. But he said that this should be the starting point of all of our deductions. He was a very logical guy and thought in terms of deductive reasoning and also inductive reasoning. But he was very logical, and the more you study his work, the more you realize that it is just a logical application of assessing supply and demand in the marketplace on a, almost certainly a day-to-day, if not a moment-to-moment basis. All right, so here's his line chart, the vertical line chart of the New York Times average of 50 stocks. And we're going to look at just this very first portion here from around this area up to about here. This is the trend to the upside. Now notice the couple of things here. First of all, he drew this all in by hand. And what I've done, there was a fellow in one of the forums who actually took and put a magnifying glass to this chart here and put it into metastock format, put the data into metastock format. And so the charts that we'll see from here on out are in that format. from Metastock. Hang on just a second. My dog is barking, and I'm going to just close the door so I don't have to hear him and be distracted. Be right back. Okay, sorry about that. All right, so he hand drew everything, and at the time that he was trading, the markets were open on Saturdays, and you see these little S's in here, and they represent Saturdays, Saturday's trading. And what he would typically do, he said that it was only open for a few hours, about half the normal time of a half the time of a normal day. So he would double the amount of volume on a Saturday. And he just identified all of those for us to make sure that we understood that he was doing that little bit of data manipulation and making the assumption that since Saturday was only half of the time period of the normal trading day, that a doubling of the volume was legit to do. All right, but fortunately, fortunately because of this person's efforts, we can look at a more modern charting software here. This is done in Metastock, and but it's the same data, and so we can take a look at this. And the first thing that Wyckoff talked about was a selling climax, followed by a little rally up, which has later become known as the automatic rally or the technical rally, and then a secondary test. On the selling climax, now he doesn't show a downdraft that had occurred for weeks beforehand in this market, but it did. He writes about the fact that the market was coming down and that there had been a fairly good move to the downside. And so first and foremost, a selling climax will occur after a decent trend, a downtrend has been in place. Once that occurs and we reach the bottom of the trend, we'll know it, he would say, because of a couple of things. On a selling climax, we will see volume expand dramatically. It's probably the most important thing to see, is that volume increases quite significantly above all other volumes that have occurred on the daily chart. And in general, on the way down, this had been trading around 2 million to about 2.5 million shares. But as we approach the bottom here, we see volume expand dramatically up to 5 million shares, twice the normal amount that was occurring in the markets in those days. Now, of course, today we're in hundreds of millions of shares, if not larger in some of the more actively traded shares. This gives you an idea. It's just relative volume. It gives you an idea that buyers and sellers at the same time were very active on the climax. And we would know that in part by the volume expanding dramatically as it does, but we would also know it as the ranges of the bars, the range being the difference between the high and the low of the daily price bar. Sometimes we call them spreads. So the ranges or the spreads will increase dramatically as well. Now, ranges or spreads, especially when they start to expand, or when they contract, which we'll talk about later on tonight, it's also a measure of activity. So volume is a measure of activity, and we see that expanding, and we see the ranges or the spreads of the bar expanding dramatically. So that's also a measure of activity. And what Wyckoff talked about was that on a climax, on a selling climax, activity expands. We see both a large amount of selling and a large amount of buying, both simultaneously. And he said that selling was done by weak hands, the public, and buying was done by stronger hands, or the, well, we might call them the smart money today, or the professional traders, the larger traders, stepping in and seeing value there, or a good bargain, because prices have been marked down to very low levels, and they will step in and they will buy. And you can see that buying occurring right here on this bar. We have the largest range, or the largest spread, all the way down. We have the largest volume occurring. And notice that the price bar dips underneath the low of the previous bar here. Lower prices were had a little bit, but somebody came in and bought and dramatically rallied this market all the way up and closed it on or near its highs, and closed it above the bar before that, and the close of the bar before that. So all the selling that occurred, and there was a lot of selling as we see all this volume here, all the selling that occurred on those 3 days gets wiped out in one day. It all gets erased here by 1 day of buying. Strong players coming in, buying the shares that are being, that the weak holders, the public really, the average trader. And these are the folks who are not well capitalized, can't really read the market all that well, trade a lot on rumor, and are easily shaken out or easily scared out of their positions. And what Wyckoff viewed this as a panic selling by weak holders, and then stronger holders we might look at in terms of hedge funds today, or large institutions like big mutual funds, or big, you know, the big trading houses like the Merrill Lynch is no longer with us, but Goldman Sachs and J.P. Morgan, those larger trading houses, they would identify this as an opportunity, and they would step in as the public is selling their shares. They would be coming in to buy. And we would get a little technical rally, the market would come up, and then Wyckoff said that it had to be tested. This market has to be tested. This climax, I should say, has to be tested. That we don't typically get a V spike reversal off the bottom. A V spike meaning that it comes down and then starts rallying right away from there. We rarely get that. Maybe 10, maybe 15% of the time we will see that. Typically, though, we will see, and we want to see, a climactic action occurring, a little bit of a rally up, and then coming back down into the area of the climax. And sometimes it comes in right to the low of that level, a little bit above, as we see here, or sometimes even down below the level of the climax. But we will see now that climax occur on narrower ranges or spreads here compared to the climactic action that we see, right? So we'll see narrower ranges and narrower spreads, meaning that the activity to the downside is diminishing. And also volume will be less. And we see that volume is substantially less than it was on the climactic couple of bars here. Okay. So that suggests some testing that's going on as we come back into the area of high volume on the selling climax. Okay, so let's just take a little bit of a review here. Does this need for testing refer to a climax on the intraday? Good question, Scott. And I would say, yeah, it does. We will see climaxes occur on the intraday, and I'll show you examples of that tonight. And I always like to see them tested. Occasionally they don't. That's a V-spike reversal, and I'll show you how you can deal with that as well tonight. But in general, what we want to see is, I do anyway, I want to see climactic action occur and then a test to follow. Okay. Now, so let's just review this. Climactic action occurs after a large downtrend has already taken place. We see that the ranges of the bars expand. We see that the volume expands. And something I haven't talked about, which is that on most climaxes, on most selling climaxes, and also on buying climaxes, which is the reverse, which we'll talk about too. But on most selling climaxes, the downdraft will become almost vertical. And I'll show you some. Wyckoff didn't really give us, he talks about it, but he didn't give us the data for it, at least in this market, because he starts it on this day here, which I think was December 8th, 1930. So we don't get to see what happened earlier. But I'll show you in this whole idea of the climactic action. We're coming down, and all of a sudden we plummet. Okay, and we get very oversold here. And we see the widespread bars coming in and the big volume coming in. Those are the key indications of climactic action. We'll then from there see a technical rally, and then we want to see this market come back into about the same, a little bit above or a little bit below the level of the climax. And we want to see volume diminish, and we want to see the spreads or the ranges of the bars also begin to diminish. Now, what do you notice here on these last three bars? That's an important Wyckoff concept. What is it that we notice here? What sticks out in everybody's mind as we look at these last three bars here? Lower closes, yeah, that's right. Cluster of closes, that's right. Tell me a little bit more about it. It's closing on the lows, no question. So it looks negative, right? But there's something here that's actually quite bullish. And Jeff points out cluster of closes. If we look, let me erase all of this so we get a clean shot of this. If we look at these last three bars, all the closes are within, here's 140, and here's 140 and a half, and it doesn't even get up to 140 and a half. They're all within a point or maybe a little bit, point and a quarter of one another. On an index now, that's pretty big. That's pretty tight action. What that's saying, this cluster of closes, and we'll see more of this tonight in other charts, but what this cluster of closes is saying is that price is refusing to go down any lower. So it may look negative because price is closing on the lows, but in fact, over 3 days, there's no further net progress to the downside. And that's seen in this clustering of closes. We also see a couple of days where volume picks up a little bit, and yet no downside movement, no further downside movement after this increase in volume. You can see, let me erase this so that you get a clear shot of this. On this bar, which is the second one in, we make just little grudging move lower from the bar before, and we come in to the same level as this bar here, right? And again, the very next bar, we see another about the same level of volume, right? And yet no net downside progress. Okay, so this is just saying to us that there's no more selling going on down here, right? It's being stopped by buyers coming in. Whatever selling is occurring, and there's a little bit because we see a little bit of volume pick up here. Whatever selling is occurring, it's just not material. It's being mopped up here by the buyers. Also, Wyckoff notes that this bar here, as we come down back into this area, we get a little bit of volume coming in, and it market just bobs right up and closes nicely here about the top third, certainly above the halfway mark of this bar. And it just suggests that as we come down, buyers stepped in. They were kind of eager to come in and buy in here. And then we see over here, they're just refusing to let it go any lower. Okay. So that's a selling climax and secondary test. A couple of questions have come in. Let's see here. Is there a rule of thumb for how close a test should approach the prior low? Not really, Jeff. It's kind of, this is discretionary trading that we're talking about. So it's sometimes it doesn't feel very satisfying to answer it this way. And so if you're not sure, then the best thing to do is just stand aside and let the market unfold. There are lots of times in the market where, even the best Wyckoff traders and chart readers really aren't clear on what the market's what it's gonna do next. There are times when we just don't know, and you might hear me say that tonight on some of these charts that we look at. It's not clear what's going to happen next. So we have to wait for a bar or two. And even Wyckoff said that in his writing. He would say, he'd be talking about a day in the market, and he'd say, well, it's not really clear what's going to happen. We need to wait another day or two, and certainly by that point, the market will tell us. So that's kind of a not probably satisfactory way, or satisfying way, I should say, of answering your question, but that is the reality of things. There's no real rule of thumb. It should be a little bit above, around the same level. This is a little bit above. At the same level would be somewhere in here, and then sometimes we'll see it come in a little bit below. It's the character of this. Look at this character here as we're coming down. Notice that as we're coming down here, volume's increasing. But what's happening here? As we're coming down, we're not really picking up that volume. Yeah, we get a little bit here in the last couple of days, but then we have the cluster of closing, and it's just, they're just stopping it here. But the spreads are narrower compared to here. Volume is not increasing on the downside, and it's nowhere near the level that it was on this climax. Okay. All right. Is that bag holding? On a minor level, yeah, it would be on the intraday chart probably. Bag holding would be more if we've, bag holding for Wyckoff was more along the lines of stopping volume. So not really quite bag holding, but you could consider it that way on a minor level, and it would be okay to think about it that way. I wouldn't object to that necessarily. We're kind of splitting hairs here. What and how does a test bar look like? Well, Sam, we're not really talking about test bars in here. If I were looking at this and looking for a test or a test-like bar, what I'd want to see is this market dip down a little bit on low volume, find no supply, and then really close up in here somewhere. I'd see volume kind of be probably something like this. So if I saw something like that, I'd call it a test bar. The other term for this is a key reversal bar, okay, at the end of a move or a trend. So you'd see that a lot. Good questions there. Here's a market, a weekly market of SPY, and this is the last down draft that we had. Here's the selling climax. We can see biggest volume on the chart. Look at that, bar none, bar none. We came in and we tested it down here, same level, but look at the volume. It was still pretty high, right? Now we come down here in March. I think this is the low that was put in March before, in 2009, before we saw the rally up. And we see volume is still high here but it's not anywhere close to the same levels that it was on these first two levels. And this is a weekly chart, by the way. So here we get a test at the same level as the selling climax, and another test occurs a little bit later, okay? A little bit higher, I should say, on a later basis. Here's one on a 5-minute chart. And Scott, you had asked about should we see a test on the intraday, and I think so. You know, I would prefer to see tests. Here's what I was talking about. As we're coming down, you can see the angle of descent, what we call the stride of descent here. And I drew this in. You see that it gets steeper and steeper to the point where it almost gets vertical. I call it plummeting down. And notice, look at the ranges of these bars. Now, this is only a 5-minute chart, so it's not like, you know, it's not we're not going to see humongous volume. I don't have the volume depicted here, but we do see the highest volume. The market dips down and closes in the middle, or in the upper third here. Not quite on its high, but it's got a strong positive close. Next bar closes up, and we rally up. As we come back down, we don't see the same kind of angled in the stride of the market. We don't see that plummeting action occurring, and we don't see the wide spreads, the wide ranges here. They're fairly narrow coming in. We get that key reversal bar here, that test bar, right at the lows, and then the market starts to rally back up. We see some volume coming into the upside as the market rallies. It comes back. We get another little test in here. Here's another one of those, Sam, another little key reversal. On a 5-minute basis, these are nice little bars to trigger a trade, because it's telling us at the end of a little move like that, or in a bigger move here at the end, we get that dip down and then a pop up, and it's closing strong. Now, notice you will see these come in as we're coming down. Look, here are those key reversal bars, right? Here's another one, okay? But it's not at the end. When it comes in at the level of the selling climax, right, then we know that it's real. This is buying in here. Certainly down in here, there's a little bit of buying going on, but it doesn't end the trend. So not all key reversals are true key reversal bars. They have to come in at the end of a move, at the end of a trend. Okay? Just to be aware of that. That's important. And then here we have the Russell on the daily. Here's an instance where we have some climactic action come in here at A. We have the high volume. We rally up. It gets tested, or maybe this is another climax if you want. I don't really get too excited about nomenclature here too much, because it's not worth arguing about whether it's a climax or it's a, you know, stopping volume or what have you. We can see, though, that buying came in. We dip down here. We go underneath the low of A. Look at the volume. Not anywhere close to where we were coming down at A, is it? And then we dip underneath again, and then we rally back up above the low of A and above the low in the close of this prior bar. And we do so on big volume. That's all buying coming in. It's all traders seeing there's an opportunity here. And they all start dogpiling into the market. Are they the smart money and the professional money? I'm sure some of them are, but I don't really think in those terms. Wyckoff, by the way, was very, very interested in who was playing, because he was a broker, and he used to he was very immersed in trading on Wall Street. And he would sit around and talk with other brokers and other big traders, and he would look, and this is how he pieced all this stuff together. He would notice when somebody like Harriman or Livermore or Gould or the there were pools that he knew about, which don't exist in quite the same way that they did back then. Today we might call them hedge funds, but then there were pools and he would be tracking those pools and those big traders, and he would look at, and he'd be able to piece this together from his own brokerage records and from talking with other brokers. Well, Livermore was buying in today, and Livermore might have been buying large amounts in here on this dip down at B, and that's what he would sort of piece together. Today, I don't know that a Jesse Livermore could control the market. They might be able to do it on an intraday basis for a short period of time, but the markets are so vast that I just tend to like to think in terms of buyers and sellers, and I don't think about professional money or smart money coming in as much certainly as Wyckoff did, and as much certainly as other traders do. In any event, here's an example where we dip down, and you have to look at it carefully, because you would think, oh, okay, this dip down was on bigger volume than what we had at A, so maybe this was the climax, but in reality, all this buying is occurring here, and the climax probably occurred over here. In any event, there was still a lot of buying, and it comes down and it gets tested. We come back down to the same level here of B and into the middle of this bar before B and into the low area of A, and we see that buying. We don't see that heavy volume here, indicating that supply has dried up, and then it starts to rally. Here we don't get the key reversal bar, do we? But notice one thing that we do get, and that is, Wyckoff talked about this, that the reason we come back down into this same area on the test, and later folks in the SMI Wyckoff world called this the last point of support. The reason we come down in there is to broaden the base. This would be accumulation occurring, buying occurring in here and in here and in here. We'll see some more examples of that later on tonight. But this testing action isn't only to test to see if supply exists, but it's also to come back down in and broaden the base here for a better rally. Now, I'm not suggesting that you necessarily try to be buying in here and picking these lows. That's not always the best thing to do. Instead, it might be a better thing to do to be buying in here at a little bit higher. And we're going to talk about, this is the trade setup that I'm going to talk to you about tonight. Buying the first higher high after it occurs, once we have some strength coming in the background. It's tough to pick bottoms. We don't know at the time that this is occurring whether it's a true climax or not. Here you might have bought on this thinking it was a climax, and yet we dip down below it again, and you would get stopped out. Now that's okay if you want to do that. You certainly do get a good price in here, but what would happen if your market starts to accelerate to the downside? Maybe there's more supply that exists in the market. We don't know exactly when it's going to stop or at what level it's going to stop. And a bar like this, frankly, is a little bit difficult to, you can surmise that we have, if we were looking at the right edge of the chart here, you can surmise that there's not a lot more supply, but there's nothing to say that the market doesn't come back down and test this level at B. So buying at C is a tough proposition, in my book at least. You can do it, certainly, and I certainly have done it, but I'm going to show you at the end here tonight a way not to, you get more confirmation. Certainly you don't get as good a trade location but buying up here, but you certainly get a lot more confidence and that the market has bottomed out and that we see the rally here and that it's a good spot to go in long. So I want to try to show you that tonight, okay? Now, sometimes a market will not climax. In these days of larger interests and multiple, we have the NASDAQ, we have the Russell, We have the Dow, we have the S&Ps, we have the Wilshire 5000, we have the value line. There's all these different indices that are out there. And we don't always get climactic action, either to the upside or to the downside. Now, Wyckoff didn't talk about comparative strength and comparative weakness in his case study, but he did in his course. And I wanted to point this out to you, that this is important. And to always be looking at some of the other markets. For example, the diamonds here and the Qs. The diamonds are the ETF for the Dow 30 stocks, and the Qs, QQ, used to just be 3 Qs, and we called them cubes, and then they changed markets, and now they're changed exchanges, and now they're called or changed, not exchanges, they changed who was the ownership of it, and now they call them QQ. So it makes it really, so we just call them the Qs. It makes it easier. But this is the ETF for the NASDAQ 100 stocks, okay? So you can see that we make lows down here, and then we rally up to this point, and everything looks all right. And then the Dow actually gets a little bit weaker here. It's coming in below the lows over here. And notice that the NASDAQ doesn't. It's holding up in here. Comparative strength coming in. The NASDAQ rallies up here to B, which is this point up here. But look at Dow doesn't do that. Dow is still relatively weak. Okay? We then come down to C, and look at what happens. We see that the Qs are holding their lows here when the Dow 30, the Dow market, is coming down. So this is an indication that strength has been building throughout this trading range in here, and that now, as we approach the lows here, and this was the March lows in 2009, and now this could be an opportunity to buy. I would wait until we get a drive up and then a reaction to buy. But this is telling you that relative strength or comparative strength is coming into the market. Okay. Now you can do this in a number of different ways. It's just helpful to know. Here we are. You can do this with stocks, individual stocks, leading stocks of the market. And if you remember, at the lows in March of 2009, here's SPY on the daily. This is the ETF for the S&P 500. And here is the, at the time, the relative strength leader, Goldman Sachs, as an individual stock. So you can do it this way too. And it shows the same sort of a thing. Here, I won't go through all of it, but here Goldman Sachs is making a higher high here, and the SPY is not. But when we come down and break down that low, look at Goldman's holding a higher high, even, or a higher low, excuse me, even in here, and then we start to rally. And then Goldman went off quite a bit higher. So you can use leading stocks, you can use sectors, you can, if nothing else, look at the 4 major markets, the S&Ps. You can look at, the cash index. You can look at the, so that would be SPX in a lot of the different data feeds. For the S&P 500, you can look at SPY, which is the ETF. It's a nice, the correlations are very high between the cash and SPY. You can look at ES, which is the S&P E-mini. So there's different ways to look at this. Then you can look at it at individual stocks, but you should look at minimum the 4 major markets, which are the S&Ps, the Dow, the Russell 2000, and the NAS 100. At least in my judgment, you should. And you'll see this occur a lot at tops and bottoms. Okay? All right, so back to Wyckoff and the 1930-31 market. After we see climactic action and a successful test. What are we looking for next? Well, we're looking for the market to break to new highs. Now, Wyckoff would say you could buy here. If you're watching this on the intraday and you could see this occur, you could buy on the climax. You could buy on the secondary test. You could also buy on a breakout to new highs. So he was a breakout player. A lot of folks don't think that's true or don't realize that about Wyckoff, but it is in fact true. He was a breakout player. So taking a breakout trade is a reasonable trade. That's what we want to see after climax happen. We want to see the secondary test, and we want to see new highs come into the market. Okay, and that's exactly what happens here. That's pretty straightforward. But notice, I said in the very beginning, one of the things to think about is a sequence of events that are occurring. And that's what we're starting to see here. Climax, a little technical rally, a testing of that. Maybe it happens in one move down as it does here. As we saw in some of the earlier charts of modern markets, it still occurs, but it can occur in different ways. Sometimes there's more than one test. Then next in the sequence is a rally up, and we see new highs come in. But after we see new highs come in, we're also going to see a corrective reaction occur. The market moves in waves, and we'll talk briefly about that tonight. Wyckoff, as far as I know, was the first person to talk about market moving in waves. And so we will see what David Weiss would call ease of movement coming up to the upside here. We saw ease of movement here as well. Elliott talked about impulse moves. So let me erase that. So he would call it impulse to the upside, right? We might call it momentum, right? A little bit of Momo here, momentum coming into the upside. So we want to see that as we're rallying up, and we'll talk about a bullish advance in a moment. But a corrective reaction then begins to occur, and we will be able to pick that up in the price bars, just looking at the price bars. Notice here we see ease of movement or impulse or momentum coming in. What's happening up in here? We're seeing price bars having difficulty moving up. David would say that it was very easy to move the market up here. It's getting more difficult to move it up higher here. We also see price bars closing off of the high. Notice here we had it closing on the high as we did here. Now we're seeing them close more erratically and not making much progress. Wyckoff also talked about something called shortening of the thrust, which is just becoming more and more difficult to move this market. We're not seeing the ease of movement. We're moving up, and we come up, and we come up, and we come up, but 1, 2, 3, 4, 5, 6 days, and we're making just very, very little bit of progress. The thrust, as he called it, is starting to shorten. Okay, so this little shortening of the thrust and the poor closes and stuff, just indicative of a reaction coming up in the next swing. And here, in fact, is Wyckoff's corrective reaction. Here was the shortening of the thrust. Here was the breaking to the new highs, the impulse or the ease of movement here and here. And now notice we come back on a reaction. And as we react, again, look at the spreads or the ranges. They're relatively narrow compared to the rally up. The volume was good as we moved up. Now we're receding here, okay? Wyckoff noted this bar in particular. I would probably go long on something like this, but where volume comes in, 1, 2, 3, I'm sorry, where volume had come in the bar before to the downside, and then nothing occurs. We don't get any more real downside progress. That buyers stepped in here. We do get another couple of bars down, and we get, once again, that key reversal here. So there's ways to play this corrective reaction. You could go in and buy here, somewhere in here, either on this bar or on this bar. And as we come down, the volume dries up. So you can do that, and I would be placing a stop down below here. We don't really want to see this market come below this impulsive move up or this ease of movement up, right? Or you can draw a little trend line in, and you can take it on a break. You can say, okay, I'm going to, and a good rule of thumb is just to use the prior 2 or 3 bars and just buy the high of that, just a tick or two above the high. And if the market rallies up, it's going to stop you in, and presumably it will continue up higher, okay? So a couple of ways to do that. Here's more modern markets. Here's the ES, the S&P E-mini futures. Notice what we see here. We get that plummeting action with wide spreads, big volume coming in, some sort of climactic action here on the intraday. We get a gap down. They're always kind of fun, right? And we rally up. We test that. Notice the volume is lighter here and the spreads are smaller than when we came down over here. We rally up, and then we break to new highs at this point. We do so on nice volume coming in, and I boxed that off in green. But notice shortening of the thrust. It's virtually the same as in 1931, and this is 2010 on a 5-minute chart. Right? And if you're, looking at gaps and stuff, it's not a surprise that it comes in. But as this market reacts, the volume dries up, the spreads are narrow, and then it's only a 5-minute chart, so this stuff is going to happen quicker, and then we start to rally up again. Right? So you can see that breaking to new highs and that corrective reaction happens in modern markets, and it's happening on all different time frames. Here's a stock on a daily chart, and we have the breaking to new highs. We get that little bit of shortening of the thrust, and then as we react back, the corrective reaction is done on narrower volume. And I'm boxing these in because I want you to see this. Here we rally up, we come to new highs again. The rally up is on good volume. But once again, we're getting that shortening of the thrust, and it's just telling us in advance that we're going to see a corrective reaction. Here we get one. It's a little bit larger, or a little bit longer, I should say. But look at the volume on that. It's not even close to what we were seeing on the rally up. And so, not surprisingly, it rallies back up again. So again, we're starting to see the sequence. I'm going to remind you of that. Climactic action, technical rally, testing, break to new highs on good volume and good spreads, that impulse or momentum or ease of movement coming up. Then we see shortening of the thrust. It tells us in advance we're going to see that corrective reaction. If that corrective reaction comes in on low volume, as it does here, we can expect another leg up in the sequence. Okay, another swing up, another wave up. All right, how does that seem to everybody? Does this make sense to everyone? Let me get a little bit of feedback here, make sure no one's falling asleep here. Is this helpful to folks? Are we seeing this now kind of in a sequential? This is the way to think about rallies. Okay, we want to see sequences here, and we see it by the market action. You can use indicators too. I do. I'm not suggesting you don't use indicators. You want to see. If you're using a momentum oscillator, you want to see new momentum coming in. If we're looking on the intraday and the S&Ps, I'm a big fan of using the New York Stock Exchange ticks, the number of stocks that are trading up from the last price versus down from the last price. So I want to see those ticks making new highs if we're making highs here. It's another way to measure momentum. Okay. Good, Elaine. I'm glad. Helpful to see these patterns. Here again, we see break to new highs, right? This is the sequence. Look at the volume come in. We don't get the big spreads necessarily on this, but a little bit we do, certainly. And then we get that shortening of the thrust, a little bit of a different flavor. This is ConocoPhillips on a daily, the great Wyckoff kind of market to watch and trade. And notice as we come down, look at, we make that clustering of the closes all in here. A little bit different look, but still the same. And then at the very end, we get that key reversal coming in, okay? And then we rally up from there. All right, so now we've seen the climax, the technical rally, the secondary test, or the testing, the break to new highs, the shortening of the thrust, now a corrective reaction. And now we want to see, is it we going to continue to have that bullish advance, what Wyckoff called a bullish advance. All it is just, you know, you can see the closes now are all closing on the high and one after the other here. We're not getting a lot of, you know, back and forth movement. We're not getting any price bar overlap like we've got over here. Now we're looking and we're seeing an advance come, and we're seeing spreads or ranges expand a bit, meaning activity is occurring. The close is coming in to the upside, meaning that activity is ending the days on the bullish side, and we're seeing volume expand as we rally up. Don't get seduced into the idea that high volume on up bars is always a negative thing. It's not necessarily negative. I know some of you will have heard that before. You have to put things in context. And when we're lifting off from a low here, as we are here, and we're seeing volume coming in, get excited because that market wants to go higher. So now on this chart, which is a 5-minute S&P chart, I'm just showing bullish advances here. Again, the closes are all above one another. The spreads are wide. The volume is increasing. On the reaction, look at what happens. Here, again, bullish advance, wide ranges, good volume, closing positively. Even up here, you know, if you're looking at these markets on the intraday, you can see this on a 5-minute chart. We see the closes are strong, the spreads are wider, the volume increases. Same thing here, okay, and over here. Just a different way of looking at it. Probably the most important thing to see here. Here I did it a little bit differently on this chart. What I did is just highlighted the advances in yellow, and you can see, I brought it down here, you can see the volume expands to the upside, okay? And as we react, each of these reactions brings out lighter volume, okay? This is sort of stepping back, having that soft focus and looking at your market. On this chart, here's just another way of looking at it. We have, as the market advances, we see volume expand. I drew those in green. As we react, I line this off in red. Just different ways of seeing the same thing on different markets. And you can see that we have reactions are on less volume, okay? And that's a sequence we see all the time. All right. Now, I want to move on. Very few, if anybody else that I know of, talks about this idea of absorption, but Wyckoff certainly did. And here we had the climax, the technical rally, the secondary test, break to new highs, a corrective reaction, then a bullish advance, and now we come up to the level of the previous high, and Wyckoff tells us there was also some movement over in here at a prior date that we don't get to see on his chart, but he acknowledges that it was there. and the market just hangs here. Okay, it just stalls out. And if I remember correctly, there are 19 days here of sideways movement where no real progress is made. But notice what happens here. We dip down and we get a little bit of volume coming in, but look at how the market just bobs right back up every time it dips down. And look at this dip down here, which is, I think it's this bar or this bar. No, it's the first one here. I'll make it a little bit longer. No volume comes in on this dip down. And then as we continue to hold and just hang right near the highs here, we see volume start to pick up. Now, we don't always see this, but we often see this in absorption, where volume starts to pick up right at the end of the trading range here. And that just indicates that buyers are getting more eager to come in and buy, and they're looking to drive the price up. This is called absorption, and this is absorption of supply that existed over here, a little bit of supply that came in here, and also Wyckoff tells us at a prior date in the market there was much more supply selling that came in. Okay, and what's happening here is that people went long in here prematurely, and over here as well, and they got excited as the market's moving up. They went long, and they've sat through, the folks who went long over in here sat through all of this down here. The folks who went long here sat through, 3 weeks here, and now 4 or 5 a month later, and there's no, net increase to their bottom line from the trade that they made. They've sat through all of this. And now as the market comes back up, they're very happy to get out of their trade. So this is just absorbing whatever residual supply exists. Another way to think about this is that the market is holding its gains. Okay, it's not giving up. Here we see a reaction down. This is a pretty good wave down. Here we're just going sideways, really. We're not really going down. In fact, just the opposite. We dip down a little bit, and now supports are lifting as we get deeper and deeper into the trading range. Okay, this is absorption. It's different than a corrective reaction, and it's important to note because, in fact, it's quite bullish. Here, on a more current market of MWV on a daily basis, we see an awful lot of trading that's occurred over here in this area of the chart. All right, we see that bullish advance come up where volume is expanding, and we get to that same level, and we just sort of hang here and go sideways. Notice again that couple of things, that we dip down here and we pop back up. We dip down, we pop back up. We see volume decrease as we go along in this trading range until we get to the very end and we see the volume start to pick up. And that is just a cardinal sign of absorption. Just whoever went long prematurely over here, they're just getting rid of whatever residual supply exists before the market can go higher. So that doesn't always occur in the markets that we trade, but it frequently occurs. Here's a couple of more examples of it. We see we rally up and we just hang here and go sideways, don't we? And we see the supports lifting here a little bit. We just don't see anything moving down, and right at the very end we start to see volume increase. Just a nice indication of absorption. We rally up higher. Notice we break to new highs. We have our corrective reaction. Volume dries up. We rally up. Increase in volume, increase in spreads or ranges, you can see. And then look, if we turn our eyes over to the left-hand side of the chart, we see a lot of activity in here. And what are we doing here? Just going sideways. Well, odds are very good that we're just absorbing that supply that still is hanging on from way back over in here, really a year earlier. On a stock chart, that's not uncommon. We'll see it many years from before. And they're just absorbing that whatever residual supply exists before it rallies up higher. So it's useful to note this. And here we are on a 5-minute chart of the S&Ps, my favorite market, where the market opens up. Here we try to rally up, but some supply comes in. Some premature buying goes on, I'm sure, as we're breaking up here above new highs for the morning. But we dip down, they get shaken out, and then look, we rally back up. We don't get much of an advance here, but we just hang here sideways, and the volume dries up as we go sideways. It's just indicative of absorption. Here we're going for maybe 30, 35 minutes before it breaks to the upside. But again, it's just a 5-minute chart, so we're not looking for hours and hours and hours of this stuff. Is absorption always paired with another accumulation area of the chart? Not necessarily, Lewis. It's always paired with a supply area on the chart. So here you can see that supply came in, and there might have been other supply in the overnight market. I don't know. I forget this chart. So they're just taking whatever supply exists from here. That's all. Do I take into consideration the time as in the dead zone, lunchtime? Yeah, a little bit. You would take that into consideration. But more importantly, Karen, is that this thing just doesn't react. It doesn't go lower. Okay, here we get a reaction. See the difference between this reaction and this reaction? In this one, we're just going sideways, holding our gains. We made a little, look at it this way, we made some gains from the lows here, right? Our low is at 86, and now we're up 92. So that's 6 points in the S&Ps. That's not a bad move, right? And now we're not reacting. We're not going anywhere lower, okay? Here we reacted from, about, say, 93 down to 87 or so. So we had a good reaction here. Here there's just no reaction. We're just going sideways, okay? Wyckoff also called these resting periods. I'm not sure why he called them resting periods, but you can see that it just meant that there was no reaction whatsoever. So back to the 1930-31 chart. Isn't this cool? I love this. Here we have the climax, the technical rally, the secondary test, the break to new highs, the shortening of the thrust, the secondary reaction, bullish advance, absorption, right? And now we advance again. And notice we get big volume coming in, and we start to close off of the highs up here. So Wyckoff even says that this might have been the end of the market here, but it wasn't quite. The market holds its gains once again and talks about how, in fact, the market starts to fall here on this bar, but then nothing happens to the downside. It just holds its gains and does not go further south. And so it indicates that you could even put another long position, if I remember correctly. And I might be confusing this with another study he did. But I don't think so. He said that you could even go long in here or add to a position. In any event, here we come into a buying climax. And let's be clear about this. You know, we've been talking about the bullish runs up and how everything has been bullish so far, and it has been, except that now at 1 we come into a climactic area. We see spreads are widening. Now we don't see it quite that clearly because we're gapping a lot, but if we extended, a little trick that David taught me, that if we thought in terms of average true range, a concept at least written about by Wells Wilder back in the late 70s, average true range is either going to be the high and low, or if there's a gap from the previous close. So if we start to extend that, we can see that these spreads or these ranges are a lot larger when we go from the close to the high and the close to the high, when we take into account the idea of average true range. rather than the actual or absolute range, then we can see this as having much more activity than what is depicted when I erase all of that and we just see the little ranges here. Okay, so keep that in mind. Keep in mind the idea of average true range when you're looking at price bars as well when there's gaps like this. Wyckoff didn't really focus much on exhaustion gaps, but this is one of them. This is where we're seeing a little bit of an exhaustion gap come in. That was Schaubacher, and Schaubacher was the editor of Forbes magazine, and he wrote some really wonderful stuff as well. And I think the Wyckoff folks and the Schaubachians, if that's what you call them, I don't know what you would call them, but they were sort of at odds with one another. But frankly, I look at both as being really helpful. And there's a couple of books out that are available by Schaubacher as well. So those are good resources to read and look at. In any event, we're really talking about Wyckoff. So sorry, I didn't mean to get off on the track of Schaubacher. But at 1 here, I numbered the price bars. We're seeing huge volume. Now we're back up in that 5 million share level, right, which we haven't seen all the way up, and we haven't seen since here. We started to see a little bit of it here, but we don't really see it until we get to here. So potential climax. However, look at bar number 2. Look at what's happening here. Volume is sustained on a down bar, right, all the way through so far. If we look at this bar, which I'm pretty sure is 1, 2, 3, is here, volume recedes, right, as soon as we start to drop off. Same thing over here, which I think is this down bar here. Volume dries up right away. Same thing over here, which is, I think, this bar, if I remember correctly. Volume dries up on the reaction. But look at 2. Look at the volume that comes in, and even more telling as they try to rally up on bar number 3, and they can't even get above the high here of the previous bar, bar number 2, and it closes poorly, and even more volume. Okay, it does close above the bar, the close of bar number 2. So some of you might think it's bullish, but it's really not, because sellers are just swamping in here, just swamping. And also notice that we have this same kind of, if we draw the trend lines here, we have from the climax low to the corrective reaction to the end of the absorption, we've got one, and then you get a little steeper, and then you accelerate here, excuse me, right at the end. And so the acceleration of the upstride here in the trend, but really the high volume and the telling volume coming in, especially on this downside, it just says that there's selling going in, and there is a lot of supply swamping demand. Okay, so we see that in modern markets too. We see climactic action occurring. Here we are on a daily chart of a stock, and we see that stride increase. You can easily see it here. We have that humongous volume coming in, bigger than anything else we see on the chart. And you can measure this by the biggest volume that we see. If we've been going along in a trend like this, measure it from where we started. Okay, and here clearly is the biggest volume since the start of the uptrend. Okay, and volume kind of recedes back, but look at what happens on 4. Volume picks up on 4, and that just tells us that supply has hit the market. And we get a little bit of a, kind of an up thrust here, and then we go sideways for quite a bit. We're no longer in an uptrend. So a nice buying climax example. Here we get another kind of example where we get that acceleration. We instead of plummeting now to the downside, we're plummeting up to the upside. Kind of a reverse plummet, I guess. But we see the very large volume coming in, largest volume that we see here, and we get poor closes, and then we're going, this is what we get, this climax and a ledge type formation, and then supply comes in a little bit later over here, and then we start to pop off from that. So a little bit of a different flavor here than what Wyckoff had seen, but you get the idea. The key things to look for in climactic action are going to be the acceleration in the stride of the trend, the wide ranges at the end, the fairly poor closes, the big volume, and then we should see pretty quickly volume start to come into the downside, whereas earlier in the trend we see volume dry up to the downside. Okay, so that's the sequence of a bullish market. Climax bookended by climaxes, and we see testing, we see bullish advances, we can see absorption, and we see corrective rallies. But as long as those rallies are corrective, and as long as we haven't expanded the stride of our uptrend, and we didn't get really wide-ranging bars and big volume, then the odds are good for us to continue that trend. And that's something to study and think through carefully as you look at trading the markets and understanding the overall market. Are we in an uptrend or are we in a downtrend? Okay. And that's what I want to say about Wyckoff in the 1930-31 market and how it gets applied to the modern markets. And if there's any questions about that, go ahead and ask them. Do we see buying climax as much as selling climax, or more of an exhaustion of buying? Good question, Scott. We will see selling climaxes more frequently than we see buying climaxes. A lot of times we will see, especially in the indices, the S&P or the Dow or the Qs, we'll see that loss of momentum occurred. So always, always, always do the comparative strength and weakness, and you will see the markets, you'll begin to see it in advance. Throughout a bullish trend, you will see the markets pretty much go in lockstep. As we come to a point where, there's a corrective reaction due, one or more of the markets will show a lower high for sure. You'll start to see it come in there. And as we get to the bottom of a corrective reaction, you'll see one or more of the markets holding higher lows or holding up higher. It's another clue that this move is over. But sometimes we won't see that buying climax occur, and we will see loss of momentum. And we will almost invariably, I can't think of an instance where this didn't happen. We will see in the major markets, we will see weakness come in, and one of those markets will show, at least one of those markets will show a distinctively clear lower high, or it'll start to show weakness earlier than the other markets. So that's a good way. If we don't see climate, you always want to be looking at all of those markets. So it's a good way to think about that. Okay, good question, Scott. All right. Now, how can we use some of this information from Wyckoff and use it to our advantage in trading the market and reading the market by its own actions? So I'll show you what I do. This is kind of the things that I look for. I'm looking for stopping volume and climactic action. We've seen that, and we've talked about the accelerated movement on very high volume with wide ranges and poor closes or good closes, depending on which our perspective is. I'm always looking at supply and demand, always trying to assess that. And we'll talk about how we do that as we go on. And also things like no supply, lack of supply or lack of demand at the tops of moves or the tops of rallies or the bottoms of reactions. And this is the testing action that Wyckoff talked about, the secondary testing. Okay, always looking for testing. It's not necessarily that I'm buying on those tests. Sometimes I do, but not, or selling on those tests, but I'm watching them carefully. Okay. I'm looking at something Wyckoff talked about. He talked about effort versus result. Effort of the buying or the selling with the result, which is nothing more than the volume and the progress up or down. We talked about shortening of the thrust, right? And that's one of the things that we see. We'll talk about capping of the market in a minute. It's another way to see this occur. And you'll often see low volume rallies, which at the end of a rally can be an indication of loss of momentum. Okay, I'm looking for ease of movement or impulse or momentum. And we talked about that here, the wide ranges, closing on or near the extremes, and we want to see that volume increase. And then the confirming retracements. Right? We saw this lots where we see the volume recede and the spreads narrow down. And we talked about shortening of the thrust, failure to follow through. These are springs and up thrusts. This came later in the Wyckoff history, I guess. Wyckoff died fairly early in the early 1930s, but he left money and created this, what was called Wyckoff Associates back in the 30s and 40s, and eventually became known as the Stock Market Institute, SMI, and that's what it's called today. And today it's still in operation. And there was a fellow there by the name of Bob Evans who, you know, he's like, he would have been Wyckoff too, I guess, or Richard Wyckoff Jr. He expanded the course a bit and looked at different things like the failure to follow through to the upside, which would be called an upthrust, or to the downside, which would be a spring. A couple of my favorite trades that I'm always looking for. I'm always looking at the bar, and I'm always looking at what it's trying to tell me. I'm looking at the range, whether it's up or down or level, and the position of the close. And I really should say, and its relation to the other bars, other recent bars, and what it looks like in terms of the overall background of the market. And then I'm also looking at how price and volume is interacting with trend lines. And I'm always particularly interested in the horizontal lines of support and resistance. I certainly look at you know, the diagonal lines, the trend channels, but it's the horizontal ones that I really like to look at carefully. I won't read all of these, but some interesting or some useful things that Wyckoff wrote in his courses or his readings. He said this one is always made a lot of impression on me. The study of responses is one of the most valuable in the tape reader's education, and we can today call it chart reader. Sorry, I'm trying to do this with a mouse, so it often looks like I'm a school kid writing in the first grade or less. So the study of responses is one of the most valuable in the chart reader's education. It's an almost unerring guide to the technical position of the market. And that comes out of Studies in Tape Reading, and he wrote that as Rollo Tape, a pseudonym or a pen name, but it was Richard Wyckoff. So the study of responses. How's the market responding to what just went on, right? We see the bullish advance. What we want to see, the response being a corrective reaction with narrow spreads and light volume. When we see that climax occur, we want to see the technical rally, but most important, we want to see that testing. That's the response we're looking for, okay? Whenever you see high volume suddenly appear on your chart, stick a wad of peanut butter on it and mark it. You may not know what it means right away, but that volume is important. This is Bob Evans. And that's true. Whenever you see high volume, we often don't know what it means right away, but that high volume, especially at the end of a trend, or after a trend has been going on, we don't know necessarily that it's ended at that point, but after it's been going on for a while, when we see that high volume, you know, just mark it because it's important. Wyckoff, again in Studies in Tape Reading, said, when a stream breaks through a dam, it goes into new territory. Likewise, the breaking through of a stock is significant, for it means that resistance has been overcome. The stronger the resistance, the less likelihood of finding further obstacles in the immediate vicinity. Dams are not usually built one behind the other. I always like this. This really made a lot of sense to me. Once a market breaks through, especially if it's been trading sideways for a while, you know, the odds are so good that it's going to continue because resistance isn't built upon resistance. Once we break through that resistance, clear air is usually in the offing, higher prices or lower prices if it's breaking through to the downside. Wyckoff also said the most important thing to know about the market is the trend. And he said this in his first course. But then in his course on tape reading and active trading, he says, but you must always be on the lookout for a change in this immediate trend. And this is how you detect it. In an uptrend, the selling waves begin to increase in time or distance, and the buying waves shorten. We'll talk about this briefly tonight. Either or both will be an indication of a change in the immediate trend. May not mean that we're going to totally reverse, but that the immediate trend we may see that. So when the selling, if we're in an uptrend and the selling waves begin to increase in time and distance, or the buying wave shorten, see, buying wave, buying wave, buying wave shortens, selling wave, selling wave, selling wave increases. That's an indication of a change in the immediate trend. We'll look at more of that in a bit. So let's take a look at a couple of applications of this using these basic principles from Wyckoff. Oh boy, we're going to go way over time here. It's already almost 2 hours, isn't it? Well, sorry about that, folks. I guess I could stop here, but I am imagining you all want me to keep going. So I'll ask this. Do you want me to take a break for 5 minutes, or do you want to just keep going? I'm happy to do either one, but I'll poll you all. So I got keep going, break, 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 keep going. Okay. Keep going, keep going, keep going, keep going. Take a 5-minute break. All right, let's take a couple of minute break. Okay, 3 minutes we have. All right, let's just take a quick break. And it's now, I have 6:04, so we'll get back here at 6:05. I have just turned 6:05, so we'll come back at 6:10. And then we'll start up again. Okay, so we'll take a quick break, and then we'll go probably another hour would be a guess, and then we'll conclude. All right, so I'll be back in a few minutes. Okay, so we'll get back. Let me know that you all can hear me all right and that everybody's back. Okay, good. What's the difference between, GJ asked a good question, what's the difference between supply and selling, demand and buying? Well, no real difference. The market works on the principle of supply and demand, or buying and selling, or selling and buying. Supply is selling and demand is buying. So no real difference between the two. All right, so let's start in here. Here's a 30-minute chart of the S&Ps, day session only. And we have a low in here that's put in, and we rally up. And notice when we get to this rally, in fact, it's unclear the first couple of bars whether we're going to just try to absorb through here or whether it's going to fail. And in fact, this does fail and starts down. Okay. Now at B, what do we notice here at bar B? We see volume increase. Supply is coming into the market as we are approaching a support point over here. That typically indicates that support will break, and in fact it does. So when you're seeing wide ranges coming down, as we do here, and volume increase as we're approaching a support point, then the odds favor that we're going to break through that and go lower. And that, in fact, is exactly what we did. Okay. So we now know that supply, or selling, is rampant through here. And we come lower. We try to rally up, we come down lower, and at this point we make a lower low off of this low from here. Okay. Now we're in a defined downtrend. I define downtrends as lower lows and lower highs. We made a high here, but now we've come down. We've actually started to make lower highs in here. As we rally back up to C, notice the character of this rally. It's pretty, what I would call lackluster. The spreads are narrow. Volume is, not in keeping with any kind of good rally. Look at when we rallied up over here. Look at how the spreads were good and the volume increased on this rally. Over here, the character is totally different. We're just kind of moving up kind of grudgingly, and not much volume is coming in. At C, we do see this little pop in volume, and we're coming up into well, let me erase this so you can see this clearer. We're coming back into where we see supply occurred here, and we've also got this high that was made 2 days ago, it looks like, over here. And we've been rotating. We come up to this level, we come down, we go through it, we come back down to this level, all the same area in here. We come back down through it. Now we're coming back up into it. But we know that supply has already pushed us down through here at B and the bar after B. We come back up into it, and we're not really able to overcome it. Often, this would be a minor buying climax here on C. We often see this, where we have just this little anemic rally, then all of a sudden the spread widens up, and this occurs over a couple of bars, and the volume picks up and pops, as I say, and then we break and come back down again. Okay? Everybody see that okay? Fairly relatively weak rally, then a pop, climactic pop into an area of resistance and an area of supply. Okay? And that takes us down, and we hold in here, and the next day we drop down, and now we come into D, and we see some buying come in, don't we? So, certainly a lot of supply, big volume here, but we see some buying come in on D because of the close and the large volume that we see. And this is the first time that we see kind of an up bar here with big volume on it. And we're getting oversold, what we would say is oversold in the trend channel here. I drew in a trend channel in red. We didn't get very far up. We come back down here at E, and we have more volume come in, but once again, we're oversold here. Excuse me, oversold in the trend channel, and buyers step in. And you can see that the closes are pretty good, and then we start to rally up, okay? Now, here we break above not only this high, so for the first time we're putting in a little bit of a higher high here, but more importantly, we're breaking the downtrend channel. Even though it wasn't a big break, it still is significant. Excuse me, it's still significant. When we come down, looks like there was some sort of news that came in at this point, because we get this humongous amount of volume for this time frame. But notice that the dip down holds at the low of E, and we rally up, and we rally up strong. And now clearly we've put in a higher high, and we are way outside of this trend channel. We dip back down into this same area at G on less volume, but there's still some pretty good volume. We come back down in this area, which is this volume over here, and then we start to rally up on good volume and good spreads all the way up. And we break up above, create that new high, again on good volume and good spreads. We go sideways. Look at, we're in an absorption section here, right? And if we go back, where are we finding that supply? Right in here, all the way back to B, and maybe right all the way back over to this high here. So we have this little axis line here, what we call an axis line of the market rotating around, and it happens here. And so we see absorption here, we break through, test it one more time here, and then rally up. Okay, so just looking at the price bars and the volume like this, and bringing into the idea and bringing into account the Wyckoff principles, we can start to really see how the market is unfolding. And one of the point I want to make here is that, remember we talked about the broadening of the support. Well, it's the same thing here. We see the market dip into this area here and here and in here and in here and even down here, and we don't see it go any lower. So all the buying that's occurred in here is what we would call, what Wyckoff later called accumulation, and then that allows for the rally to occur. Buyers bought in here. We can see the buying in all of this area here at D, E, F, G, and just before H. We see the buying that's occurring in here. And so larger traders presumably are acquiring a line of contracts in this case, or stock. And once they have that line, they mark up the price, and then they start to sell it out. Up in, you know, this area here, they would sell off some of the shares that they bought down below in here. And that's the idea of accumulation. But you can see it when we go sideways like this and we see the buying come in. And I'll show you another example of it a little bit later. All right, here we're on a 5-minute chart, so things happen fairly quickly on a 5-minute S&P chart. We come down here, buyers step in on the gap down. We have this big gap open. And we see buying at A, we see buying again at B, a little bit of volume coming in. But look at what happens at C. So buyers or demand are coming in here, but look at C. We get that kind of shortening of the thrust here, right? Look at the volume. It's the lowest volume on the day here at C, and yet we're trying to break to new highs. We're trying to go up above the morning highs, and we're not able to do it, are we? We come in here at D. This looks like it's around the 10 o'clock time frame, which is a typical time that news comes out, and we often see a reaction occur in the S&Ps, and that's what we see. But notice the big volume, the widespread. Look at the close. We're closing poorly in the lower half of the bar, and all that volume. That's selling coming in there. And so we dip down. Once again, we try to rally up a little bit here on E, but the poor close and the increase in volume just shows that we've got more supply coming in. Look again at F. We saw this last time. Widespread or range increase in volume indicates that that support level here will break. And it does. We break, we come back up, we test it. Again, look at G. We have an attempt, to rally up higher, but look at the volume. It's just very light. It's very anemic. There's no way that price is going to rally up on that volume. And then we start to come down here, and we come down to this level. Notice what's happening in here. We start to get that clustering of closes throughout. And on pretty good volume, buying has come in, and it's indicating that it doesn't want to go lower here. We start to rally up. Let me erase this. On J, and look at, we get it's kind of good movement and good volume on that rally. Buyers came in, and they drove price all the way back up to the low at A. Right? We can extend that line across. And then we don't get much volume coming in, so naturally price falls off. We're also in the noon hour on the S&Ps, so it's typically a low volume period. As we come down, though, regardless of whether it's during the noon hour or not, volume is light to the downside until we get to L. At L, we see good volume coming in. Price closes stronger than weaker. Not real strong. I would prefer to see it closing on its high, but we still close back up above the lows at I. This is a failure to go further to the downside, a failure to follow through. This is a spring, and the market responds to that spring. We saw a little bit of evidence of buying coming in around I. We see other evidence of buying coming in at J. We see a lack of supply coming through here along K, the reaction down. We see buying coming in at L. And notice now at bar 1, we see a good spread up and volume comes in. That's buying coming in. At 2, we see that narrow little spread. We came down a little bit, but look at the small volume on that little narrow range. It indicates that there's no supply in this market. There's a lack of supply at this level. And that allows the next bar to go up, and we see volume come in. On 3, we dip back down again. This is what the VSA folks would call test in a rising market, or no supply in a rising market. Volume dries up. We see a push up to new highs, just a little bit above there, and we see volume come in around that drive up. And as we react, look at the volume recedes. It's the same thing. Now, the intraday charts happen really quick, and they're a little tougher to read than the daily charts, but it's the same thing that we've been seeing on the daily charts and on the 1930-31 market. It's the same principles that occur. On 6, we have that bullish advance, and we rally up a couple of bars. And look at this. What does this remind everybody of? Let me see if you guys see what's going on here on these few bars around 7. What does this look like? Yeah, good, Raymond. Shortening of the thrust, right, Rama? Others? Good. It's the same thing that we saw in 1930-31. Here it is. What day was this? This was last week, I think, because we had a afternoon reversal, which is not always a common thing. But we see the exact same thing, and then we get a reaction down. Look at the volume. Dries right up, and then the rally up on good spread, and we go all the way right into the close, and we close firm on the day, right? It's the same stuff from 1931. It's the same exact stuff. Okay, I'm going to do this chart fairly quickly. Some of you may have seen this chart. I like this chart because I like to get people thinking a little bit on I get some good reactions from this chart once in a while. We probably won't do that because when I do this, use this chart live, in a live audience. Not that you're not live, but in an auditorium where I'm speaking and there are people in the audience there, I can get some good debate going on. We don't have time for that tonight. We'll just go through this, but you can see we've been rallying up nicely. And look at what happens on A here. The range of this bar is quite narrow. And look at the volume. It's pretty high, highest on this uptrend that we can see in this chart. Only one thing really does that. This is what the principle of effort versus result. A lot of effort here in the volume. The effort is the fuel, if you will, right? A lot of effort in the volume. Pretty poor result in terms of price. We don't go anywhere with it. So they're capping the market at this point. So only one thing does that in an uptrend, and that's supply coming in. It's like everybody wants to buy. There's a lot of buying going on, no question, because the volume is high. But for every share that's bought, somebody's selling at that same price. So it's not like prices are lifting, but somebody is standing there selling into all the buying, and that's what causes the narrow range or the narrow spread in this bar on high volume. Something to watch for. We don't see it all that often. We also see supply coming in on these down bars here at B. All these Bs, we see increase in volume. Every time we drop down, we see an increase in volume on these. That's supply, right? Last chart we saw on J, the market moved up early on, and that was buyers coming in. But we're not seeing that here. What we're seeing is sellers coming into this market. Now we come into C, and we see a lack of demand here. Volume is drying up as we go higher. And at D, we get a little bit, sort of subtle, but this is, if I remember right, it's a 5-minute or a 10-minute, no, 5-minute chart. It's the same thing that's going on here. The volume increases to the downside, and we start to come down. And over here, we make a little bit of a lower low in here. We try to rally up at E, and there's just no volume there, and price drops. We're in the noon hour, and we come down here and make another lower low, and now this time we are making a lower low below the last swing low over here. So that's significant. And you'll notice that on all of these down bars here on the way down, I put little red arrows and track them over here. And each time we come down, for the most part, we're picking up volume as we're coming down. Okay, supply hits the market. And it really gets going towards the end of the day down here. And you can see that there were a couple of good locations for selling short. And I would say the two best locations are here at F, because we're coming into a downtrend line, and we have this. I'll erase this so that you can see it a little more clearly. If I would short here at F, because we're coming into a known level of supply over here, and a resistance point over here that was support before, and also we are coming into a supply line over here, okay, the downtrend channel or the downtrend line. And another good spot is right here at H. We just have either bar, the first one or the second one, doesn't really matter. We just have supply over here to the left. We have no volume coming in and just poor closes. And the odds are good that you're going to go short, you're going to, go down from here. You can stop yourself in by drawing a little trend line across and stop in on the lows. That's okay to do. Or you can just go in, which is what I would typically do. But either way works. I would not be selling up here or here, but certainly not at C, because I don't know if this market's going to just go sideways and try to absorb through supply and then go higher, or if it's going to go higher after, a bar or two down. I wouldn't do that. I don't buy tops or bottoms. I don't try to. I try to, and that's why I included this chart. I try to let the market unfold and see where the direction is and look for good choice opportunities to make trades. And the two locations, in my judgment, on this chart are these two right here. These are the two best opportunities. Okay. Oh, hi, Erica. How are you? I will send that message to Helen. I thought she tried to call you, but I will get you that. I will get that message. Oh, and good. I'm glad to hear about your brother-in-law. That's good. Erica's brother-in-law was not so well there. All right. Let's go on to the next chart. If you have questions, just ask them, and I'll go back to charts if need be. Here, this is in. We had made highs in January, I guess, or earlier in January, maybe January of this year, and then we started down. And I remember this because I was at the New York Traders Expo at the time, and people were saying, "Oh boy, it's the beginning of the downtrend, and the bear market is going to resume all over again," and so on and so forth. And maybe it was going to at the time, but if we try not to listen to what other people are saying, and we try instead to read the market here, and what's happening, then we will put ourselves in much better position to be able to trade more effectively than trying to figure out, is the market really going to have a new leg of the downtrend, and is it going to be a double dip recession and all that other stuff. So here we're coming down, and this is a 60-minute chart of the ES, and you can go back and look at this more carefully. And I would encourage you to do this because it's a really good study just to look at this particular portion of the market. But we're coming down from the highs in early January, and all of a sudden we make the largest rally in the downtrend. I'm always looking for this. I'm always looking. Remember what Wyckoff said, that when the waves in a downtrend, when the up waves become larger, right? And so that's what this is right here, or the down waves become smaller. So all of a sudden, if you look here, I've got waves coming down like this, and all of a sudden I get that large up wave, largest rally in the downtrend. I love to see this because I know that the odds are starting to favor that the downtrend is going to be over pretty soon. Okay. Now, I'm not saying that the downtrend is definitely going to be over or that we can start buying in here right now. I say that the odds are good that the downtrend is going to be over. The odds, the likelihood, because all of this is based on likelihood and probability. Okay. There's anything certain in doing this, reading the market like this, or trading by any method. There's no 100% method, including Wyckoff. So we always are thinking in terms of odds. But when we see this large rally, all of a sudden the larger waves start to occur, then our ears start to perk up and we start looking for other signs of buying. And look at what we see here. We see, certainly this is supply coming in. Market gaps down and has a good solid down move and comes down here. But look we get large volume and we're closing in the middle. It didn't stop the market, but it suggested maybe some buying coming in. We'll come back to this particular bar in a minute. The market comes down a little bit lower, and look it bottoms here. We don't know at the time that it's bottomed, but look at this bar here. This is the largest up bar since the downtrend began, okay, on the biggest volume, and I highlighted it in red here. That's significant. It means buyers are coming in strong, okay? Then as we look for, gosh, how long? From February, early February to the middle part of February. So for the next 2 weeks, we just go sideways. And every time the market dips down, and I started to draw in this area here, and if you think about this, if we go back here, look at this. If we go back to this bar where we first see buying coming in for the very first time, they dip it down to here and it pops up. They dip it down again and it pops up and it pops up and it pops up. And notice also that the supports are lifting. I drew this blue line in, which is now kind of covered over by all my red scratches. But the idea being this, that now we can say, okay, the largest rally in the downtrend here line has, the supply line has been broken. If we extended this down, we would see that this got oversold. We have the largest up bar, that's more buying coming in. And now it seems like they're buying in this area that we're looking at. Let me erase this and show you this a little bit more clearly. If we come back to this level here and we say, gee, they're buying in here, okay, all through in here. And that allowed the market to rally up and put in the highs in April that we just revisited last week, all right, after the big flash sell-off in May and all of that stuff that we had. So it was this accumulation period in here for a couple of weeks that allowed us to rally up. Okay. Yeah, Erica says cause. Wyckoff folks used to talk in terms of cause and effect, that the effect would be the rally and the cause would be the opportunity to build positions or lines or inventory of stock in here. Yeah, and that's the zone right in here, the cause with, and we just know that it's buying because every time it dips down on high volume, we pop right back up and we can see the bars closing firmly. And I encourage you to look at any good reaction in the last couple of years, and most of the time you're going to see something like this. Most of the time. So this is a good way to see accumulation. Okay. All right. I talked a little bit about waves. I said we'd touch briefly on it, and I do want to do that. But you can see, you know, Wyckoff said, and go back and when you review this, take a look. And this is EWZ. This is the Brazil ETF. When in an uptrend, when the up waves shorten, look at this. Here we have up wave, nice and long, nice and long. All of a sudden it gets smaller, and the down waves lengthen. Here we are. We get a longer down wave. Well, you can short this. Now, it doesn't give us much satisfaction because we're in a good up wave. You got to look at time frames. So you can look at a weekly chart when you're doing this as well. But this could be, if you were trading on the intraday, you'd want to note that we're going to, you know, potentially do, or a swing trade that we could take a little short there. But the up waves lengthen again, and they lengthen until the down wave all of a sudden gets sharper here. It increases, right? And then we get the up wave is getting shorter, and the down waves now are getting here and here. They've lengthened. So now we can look for a larger move down, and certainly we get that over here. Okay. So I can only do briefly the waves, and it really wasn't part of Wyckoff's case study, but I did want to bring that into play for you so that you did have at least a little bit of a way to look at the market in terms of structure. And again, it's not perfect. It's not 100% all the time, and it can sometimes be confusing. But if you work with it and spend some time with it, you'll begin to see that the waves really do tell you a good story. So Erica says, do I look at the double bottom in an uptrend with a spring? Yeah, absolutely. And, you know, here is one where you would be looking for an opportunity to go long. And you can see failure to follow through. And we can't probably quite see it on this chart because I kind of was looking more at waves, but you can, and so I kind of tone down the price bars, but you can see buying in here and buying in here. okay? And we have another spring over here where it dips down and you can see the buying coming in. I like springs a lot. They're one of my favorite trades. So you want to look for those in uptrends for sure. All right, let's do a bar by bar analysis of a market here. This is the SPY in a while back. So we'll go through this, and I was going to try to make it a little more interactive, but we're running overtime, and I need to get through this for you all. So I'm just going to go through it. But we're in, you can see, we're in some sort of an uptrend here. And if we take a look at the weekly chart, then we certainly are in a good uptrend. And the way I look at uptrends, and I'm just looking for higher highs and higher lows, higher highs and higher lows. All the way up, we have this. Now, we've been on a good run here, right? So we can expect at some point a bit of a corrective reaction. So let's just see what happens. And again, we're back on the daily chart here. This is the daily bars. And we're in this nice little uptrend, and we're just kind of humming along. Okay, let's see what happens. Look at what happens there. Now, I don't know how you would predict that occurring, but we have just, you know, a 10-point or more, 15-point drop in the S&Ps on a SPY. That's a large amount of supply coming into the market. And look at this volume. It's just huge, right? There's only one thing you can say about that. It is supply. My goodness. All right. But let's keep going here. Let's go on. We still see heavy volume coming in, right? 180 million shares. I mean, we don't see that. What's the average? Somewhere is around 80 in here. And we're up more than twice that even on this bar. But high volume, and we're seeing buying coming into the market. Somebody stepped in and bought here and pushed the price up quite a bit and closed it fairly strongly. Is this a place to go long? No. And am I saying that this is buying coming in? I'm sure there was some buying because we got into 270 million shares here, but there was an awful lot of selling as well. So it remains to be seen. We have to see what happens. Let's take a look at the next bar here, going bar by bar. What happens? We dip down and we go lower, and buyers come in, don't they? They come in and they rally this all the way up above the low of this bar and the close, and they rally it all the way up above the low of this bar, and they close it pretty firm. That's pretty good, and they do so on strong volume. This is the first indication that we have that there is buying coming into this market. This is the first time that I would look at this and say, some buyers stepped in here. Would I be buying here? No, not at all, not at all. But it would be the first indication that I would be thinking to myself, maybe this is some sort of a shakeout that occurred, and maybe there is something to begin to look at, let's focus in on this market. And remember, on the weekly, we're in quite a big uptrend, right? So let's look here now on this bar. We, sorry, I got lost here. Okay, so on this bar, we see no further ability to rally, do we? We open and boom, we come right down. I'm assuming that the open is somewhere near the close here, okay? What's causing this? Well, a lot of buying over here. Maybe there was some buying on this big supply bar. If there was, maybe the buyers are just spent. Maybe they're exhausted here, okay? And we're also seeing a poor close. We're closing down lower now. So this, maybe buyers came in, maybe they're spent, maybe there's no more buyers, maybe we're going to see more selling here. The only plus to this bar is that we have a little bit less volume, but still 160 million shares is twice what we've seen on average throughout. So even that's not too positive, okay? What happens on the next bar? Pretty negative, right? We see a poor close. We see no ability. They try to rally it up intraday, but they can't get anywhere. We see the poor close. Now we're going down again, right? Question is, are sellers taking back control? Maybe they were. I would be thinking, they might be here. We've really only seen a couple of bars where buyers came in, and now it seems like supply could swamp demand again. And so we may not, we may see this go down lower. The only thing that's plus on this day is the lessening volume here. But that's not a lot to hang your hat on, okay? Not really a lot to hang your hat on. So you'd have to be wondering what this market is going to be doing. I said to you before, there are times in the market where we just don't know, and there's not enough here to piece this together. If I were, if you forced me to bet on this, I would bet to the downside here. And I'd be wrong, right? What we see the next bar is buyers step back in, right? We see this open up with a small gap open, so that's strength coming in. Gaps can be strength. We see the market hold that and rally up. Buyers step in and close it all the way back above the high of the previous bar, okay? So now it looks like buyers are back in play here. So we have to wait and see what happens with this. Now the jury is kind of out, but now there's a potential with this rebound where sellers really had, the way I'd be thinking about this is that, sellers on this bar really took it down, and now they have the chance to really bring it down lower. That's their objective, right? But they fail, and buyers step back in. This is unusual. We should see the market fall further, but we don't. Instead, it rallies up and closes above the high of this wide range bar here. That is significant. It means that there's some buying going on in here, and we have a higher low than we had yesterday, okay? So still, we can't make any decisions there on this, but we note that buyers came in. And on this next bar, we see once again that the buying gets a little bit spent. We try to rally up, but we can't hold the highs. We come back down. We do put in a higher high and a higher low. Close is not that great, but the volume has diminished quite a bit. So maybe if sellers had the opportunity to come in as the market was falling off, they might have been able to pull it down, but they didn't take that opportunity. Okay, so the scales are weighing more on the buy side than on the sell side, but still, it's clearly struggling to go higher here, right? But the next day it does go a little bit higher. So again, you've got to look at this as a positive, and volume is still pretty high. I mean, this is 120 million shares. At this time, this was quite high volume. And we're seeing the buyers able to push price up and hold the close here pretty well. And so sellers are not coming in. So again, we're seeing a little bit of a rally here. On this bar, we again see the low is held from the day before. The close is pretty similar, maybe a little bit higher, and the high is higher. It's still more bullish than it is bearish, okay? And we're able to drive pretty good into the middle of this bar here. So something to note, okay? Something to note in here. Not really a test. Okay, what do we see here now? Well, we don't really have the time to do too much of a dialogue, unfortunately, but here's what I'll tell you what I see. First and foremost, we see an inside bar here. This bar is inside the range of the prior bar, meaning that buying probably, when we consider the volume and the insideness and the inside range of this bar, and also it's narrower than most of the other ranges here, It is closing up a little bit higher, but this looks to me like that clustering of closes in here. Buyers are not able to muster any forces here because volume is going down. And now that we have an inside bar, we have to be aware that this market could move, could go up higher, but most likely the odds are going to be that it's going to move to the downside. An inside bar, if you're a day trader, and if it's a narrow range bar or a narrow spread bar and it's inside, it often will lead to trending conditions the next day. And that's what happens on this. We start to trend down, okay? And now look at this. Look at the high volume coming in and the wide range coming in. All of a sudden, sellers come back into the market in force, right? And you'd have to wonder, did this buying that occurred in here and on the way up, is that all evaporated now? Is this thing going to crash? I would draw a line under here. And if we see a close, remember we said that when the market approaches on high volume, on an increased volume and an increased range, the odds are good that it could break that support. We'd have to see that occur here too on the next bar. But now, you know, we'd be concerned that selling might be coming back into this market. But look and see what happens. It's just the opposite. We dip underneath and volume picks up again and we close very firm. This is a spring. This is showing that there is no supply. Lower prices are getting rejected. And we can now start to piece together a few other things. Erica said it earlier. She saw the shortening of the thrust in here, which occurs. We saw that to the upside because we were really dealing with a bullish advance, but it occurs to the downside as well. And we see that shortening of the thrust here, and we can extend it over to this level here. All springs, in fact, are shortening of the thrust, and all upthrust, which is the opposite of a spring, are shortening to the thrust to the upside. So we're seeing that. That's bullish as well. And this is very bullish here. Okay. Now, I wouldn't be buying this because, you know, I'd be looking at this at the end of the day maybe, and I'd see that there's quite a bit of a range here, so it would be a hard stop for me to place. But I would certainly notice this, and I'd be looking for an opportunity to find a entry. We rally up again, up a bit, and we don't go very, very far here, indicating that we get a little follow through, but not a whole lot. And we might see then on this low volume here, we might see this market want to come back in and maybe retest the lows down in this area in here, somewhere in there. Let's see what happens. We do come down. Notice now we're back down to the same level as this, where we saw supply come in on this volume. And look at, the spread has narrowed, meaning there's less selling activity, and the volume has dropped off. Still pretty high, but it's dropped off relative to this volume, saying that there's not a lot of supply coming in. So you might see another bar or two, you know, kind of cluster around in here, or maybe go a little bit lower, but you would anticipate now that the market would try to turn up from here because we're just not seeing that supply. Remember I said it's the study of responses, and it's logical, and that's what we're seeing here. And yeah, we're coming, that's a good point. I'm looking at what Erica's saying here. Erica's saying that we're back down here. You know, we had volume in here and in here very large, and we're in that same general area, and the volume now is substantially less. Good observation there. Very good observation. And now we start to rally up a little bit, okay? We can now say that this was most likely a test, this bar in here, and now we're starting to see a rally, and we're not only rallying above this bar before, but the bar before that, and we're making good progress. Note, and I want you to see this, we can rally on light volume, and we typically will, especially after a large amount of activity that we see. And notice we're rallying up here, and volume is light, but this is just lifting off, and that's not abnormal. That we will see occur fairly often. And now on this bar, as we rally up above, we're breaking above new highs, and in our good Wyckoff principles, we're doing so on increased range and an increase in volume. And that's bullish behavior as we break to new highs, right? And we see here that the market holds here. And again, we try to rally up now this time, and we're seeing this is a very fine bit of shortening of the thrust, but we're seeing a little bit of shortening of the thrust here. And we're also seeing, we're also seeing light volume as we try to rally higher. So we're up into the area of big supply here, a bit of a lack of demand coming in. Okay, so we can now look towards a reaction. This bar comes in, and we're clustering our closes here. We get a bit of an increase in volume. It's coming into the downside. It suggests supply. Even though it's closing pretty firmly, this little bit of background in here, I wouldn't be buying in here. I'd be looking for an opportunity a little bit lower. We come down, we make another lower close here. We've got an inside bar, an increase in volume as the market's coming down. The odds are good that this is going to try to drop a little bit further. We do so, and we're dropping, and now look at where we're dropping to. Right back in to test the area where we just broke out from, okay? And we see a pickup in volume and a close in the middle. This could be climactic, a small climax, a minor climax. The next bar is a bit of an outside bar. We're seeing closing off of the low, but we get a higher high and a higher low. Truthfully, it's a little difficult to read that bar. And then we get another one like this. Makes it even more hard to read. Big outside bar. Usually we don't see when the bar is outside the range of the previous bar like this. We get two of these in a row here. Usually both the buyers and the sellers are spent because they've done a lot of churning and buying and selling, and typically we won't see much of a move the next day. And then look at what we get here. What do we see here? The way I read this is a couple of things. First of all, we draw our support line in. We've dipped underneath of it a couple of times, and we pop back up above it. We're seeing that clustering of closes once again to the downside here. And this time we dip underneath here, and look, there's no supply coming in. The volume just dries right up. The selling just dries right up, and it just lifts right up. So at this point, you would expect it to rally up. You'd bracket the market. Yeah, I'd look to go long here. You could buy on a break of the high. You can, sort of hold your nose and buy in here. But you've got enough indication here where we certainly had supply come in, it got absorbed in through here. We've seen a spring, we see impulse to the upside, and now we get a bit of a corrective rally. It's not the cleanest corrective rally because we do get this volume coming in through here, but the clustering of closes, and particularly the last bar, which is an inside bar as well, we can expect some kind of a move up, and I would be betting that that would be up higher. And in fact, that is what happens. We gap up, and we start to move, and we rally up. I ended this chart right here. This was the gap up. but the shortening of the thrust and the spring, the impulse up and the move up. So this is going to lead us. Yeah, this is a nice spring, and you know, I would generally, on an intraday market, I'd be looking to buy springs, and I'll buy them on the daily as well. But you know, when it's a 3-point or more range here, that's a little bit harder to buy. What I want to show you is, instead of trying to buy bottoms, that we don't have to do that. We can wait and be more patient and look to buy right in this area here. When we put together some of the principles of Wyckoff, where we have some strength coming in, we have impulse to the upside, we make a new high, a higher high, and now we look for that corrective rally. I call it first new high after a down move. And what I'll do here is I'll just go through the elements of it, the first higher high trade. And, you know, this is my framework for doing it. You don't have to do it this way. I like to specify the markets in the time frame, and I tend to look at this on these are the main markets I trade, the ES, the TF, which is the Russell futures, and the NQ, which is the NASDAQ 100 futures. And I look out for this on a 5-minute chart. And I also do equities on 60-minute, 120-minute, and daily charts. So I'm always looking at the background conditions first, and I specify that out so that people understand that we need to look at background first and foremost. Then we can look at the setup, but let's identify the background first. So I want to see a decent down move or a downtrend underway, and we either have, you know, a climax occur that's been tested, some sort of stopping volume, some sort of loss of momentum or shortening of the thrust, or some other sign of strength like a spring or what have you. You can specify that for yourself. So we have this in the background. And then the setup conditions. We see that current rally. We see that bullish advance occur on wide ranges and increased volume, making that higher high over the last swing high, okay? And we see a reaction on narrower ranges and lighter volume, that corrective reaction come in, okay? So here's a couple of entry options. You can look for a key reversal bar, or I showed you earlier on that you can, on that corrective reaction as we're coming down, after we've made a nice move up, as we're coming down, you can draw a trend line and stop yourself in. You can do that. Risk reward, you should specify that. You know, it's up to you on how you do this. I like to use a risk to reward of at least 1 to 3. In other words, I'll risk $1 in the expectation that if this trade works out and is one of those positive trades on the probability scale, then I'll have a positive expectation as well. I can risk $1 and try to make $3. Okay. And you always want to place a stop, and you do that under the swing low. And on this, here's a way to look at how to measure out your profit to figure out your risk reward. You can do a measured move, and I'll show you what that is, or you can take it off at the next resistance. Either one is fine on this. I don't think Wyckoff ever talked about measured moves. I'm not sure who did, but he certainly talked about next resistance. So here's the market we were just looking at, and here's the trade we were just looking at. So we have a higher high here. We have that nice wide ranges coming up with good volume coming in. We have the shortening of the thrust. We have the spring. All the nice little the testing of that spring. All the nice little things that we can look for in terms of a trade. Now, we didn't talk about waves, but notice I got larger waves to the upside and smaller waves here to the downside. Okay, so we can add waves in if you like as well. Measured move. I would look at this and I'd calculate the number of points, and I would go from the low of the entry, the swing low, and I would put a measured move in about like that. Now this obviously goes much higher because we had all of this volume in here. All of that cause was generated. If we did a point and figure chart, I'll bet it would be pretty good size cause. You could also take it off, excuse me, right here at the last resistance. That's okay to do too. But you know, it kind of depends on what you've got going on down here, and your experience in reading this. When you see this kind of volume coming in, which is head and shoulders more than we've seen earlier before, then you know that there's been a lot of change in hands of stock, or contracts, whatever the vehicle is. And you might take a piece off here and, trail a stop after that if you like. But the idea behind this trade is this. So many traders I know are trying to buy bottoms and sell tops. And I just wanted to give you an option here, another alternative, a really nice trade setup where you don't have to be worrying about getting in down here and is this really a spring that's going to hold and is this good shortening? You can piece an awful lot of the background together and then make a good, solid, high odds trade here. And you don't have to buy the bottom. And look at all the upside you have here from something like that. Okay. Yep, Erica, you're right. The swelling of the volume shows us that the down move is over. Here's on the NQ on a 5-minute basis, the S&Ps, the NASDAQ 100 futures. Here we get some stopping volume coming in. You could call this climactic action. I wouldn't argue with you on that. You get that wide range, big volume coming in. We rally up. We don't really get a good sense that this is, so I would call this more stopping volume than anything. We don't really get a good sense that this is that a lot of buying has come in here, but we do spring this. We get a refusal to go lower. There's a lack of follow through to the downside. And buying seems to have come in on this spring because we get a nice increase in volume, and then the market rallies pretty nicely after that. We make a higher high at the end of this day, but look at what happens the next day. We open up, we gap open a little bit, and we get a little bit higher coming into this supply level over here. Excuse me. But we come down and we play around in this gap area. We get buying coming in, a lack of volume on this next bar, which is down, and then a key reversal, and then we start to rally up. So you could stop yourself in or whatever. Because we're so close to this resistance, this is an instance where I would use a measured move, and if you see, you've got a measurement from here to here, and it just about makes it. It's a little bit less than there, but you can see that gives you a target. So if your risk is a couple of points here, then your target is considerably higher in this NASDAQ. And again, you don't have to buy the bottoms. And these come in different flavors. Here's IBM on 120-minute. We get some sort of a stopping volume. We've been coming down a ways. You can draw a trend line in here and see that we're oversold. Again, we get that spring action. We get a good rally up, good strong move up, good volume coming in. This is on a 120-minute basis. So this is pretty good. We make a higher high. The higher high is above this last swing high. Okay. And then we come back down, we get that key reversal. It's the end of the day, we rally up, and here we had a little bit of movement in here, but then again, you can do a measured move, and you can see that it basically meets that criterion. Notice we get some absorption in here. Look at that, right over there at that supply level. So if you saw that, you could think about re-entering that trade or holding it a little bit longer. Okay. Here's the first higher high on my favorite market, the S&P E-mini. We come down, we get a little bit of stopping volume in here. The market rallies up, we get a good push up. We might have seen this chart before now that I'm looking at it. This might have been J. I'm not sure. Yeah, I think we did see this chart before. We have a downtrend line that gets broken here. We get this weak reaction back. We get a spring that occurs. We rally up. We don't get a huge amount of volume coming in, but if we look carefully on all of these bars coming up, the up bars are wider in spread than the down bars, and we do get volume coming in. We make that higher high above this high now. Not a great higher high, but we come back, and again, you can either stop yourself in or you can just buy, and we get that volume coming in. And once again, you can do that measured move, which would look something like this, and it meets that measured move. And here I would probably take it off as I'm going up, and we get a reversal in the afternoon. I certainly would not hold that much more than the morning high here. But again, another example of that. Now here I want to show you one. This is APA, another one of my favorite stocks on a 120-minute chart. We get some climactic action. We rally up. We make a higher high above this last swing high. We come down. And so you'd look to enter in here on this reaction. But notice this one gets stopped out. Now, not everything works 100% of the time, and I wanted to show you at least one example where we do get a failure. But I wanted to show you this too, that most of the time, this market does not, this trade setup does not just, you make a higher high here, and so you bring your stop to break even, and as it comes back down, you'd protect yourself, and you wouldn't get hurt all that much. So even on the failures, we will typically see at least a retest of this high before it starts to come back down, and you can move your stop up to break even at that point to give yourself some protection. So even on the failures, it's a pretty good trade. And here's another one, again on the S&P 5-minute chart. We get some climactic action. We get some testing occurring. If we drew a trend channel, we are way oversold in the trend channel. We make a higher high here. We've clearly broken the trend channel. We come back down into support here, which had been resistance, and then we rally up higher. Here, we don't quite, I don't think, get the full measured move, but you get a good sense of that. Here you've got, it's a pretty good stretch to be making that reversal and coming up, so you might want to think about taking it off at resistance like this. But that gives you a good idea. And then you can also reverse this and do this as a sell short, the first lower low, where you want to set yourself up so that you've got some good idea about what's going on in the background for selling. And here we've got a bit of an up thrust. I won't go into that tonight, but you can see some selling came in. The volume expands as we come through. We break that low. We make a lower low. We come back up, and you can short in here. And again, a measured move gets pretty close to that level. All right. All right. I am tired. Some resources on this. You can certainly check out my blog and website. There's a couple of free videos on Wyckoff trading that are free. I do a lot of posts. I'll do more. We're just waiting for the new website to come up. I'll do much more on, certainly on the intraday markets once that new website is up, and it's just been delayed and delayed. It's been it's going to be really nice, but it's just, birthing this out is kind of painful. So you'll see more. And there's some articles on Wyckoff trading. You'll see them on my website. Also, check out themoneyshow.com. You'll see them there. And of course, my trading techniques and courses that I do, which many of you all know, because many of you have been in them. You can see that. You can look there as well. So just sort of in summary before we sign off tonight, we've looked at the 1930-31 market, and I've shown you how it really, today's markets are not really different than those. We've looked at the sequence of a bullish move and how that unfolds, and we've seen that in modern markets as well. We've looked at taking some of those principles and applying it to a lot of the intraday charts, but also the daily charts as well for swing trading, and how you can apply them both in uptrends and downtrends. I did a little bit more with that. We introduced the idea of the waves as well to look at. And then we went through a market bar by bar, and I showed you exactly how I read that stuff. And, you know, there are times when, gee, I don't know what's going on. You know, we have to wait for the next bar or two to try to figure it out. And that happens. But if you're patient and wait and try to piece things together, you can do that. And you can, what David Weiss used to call making a Wyckoff story, you know, add shortening of the thrust and spring and impulse to the upside and corrective rally on light volume. There's a story. There's a Wyckoff story. And what I did is put that together into a trade setup for you that I call the first higher high, and gave you a number of examples on stocks and the things that I trade, stocks and the indices in the futures, and show you how that works. You don't have to try to buy bottoms. This is you can get in and get a very nice trade on a very, you know, you can, when you put together the background story on this trade, and then you just patiently wait for it to come in, you get a nice run on it. You don't have to get in at the very bottom, because you get a whole new leg up most times on this. And even when you don't, you will have an opportunity. It's very rare that the thing just goes down south from there. You get in and it just keeps going south and stops you out on your full stop. But you have to work with it and experiment with it for yourself. So I think I'm pretty tired out. That's about it for me. I certainly will take any questions that anybody has on anything that we've covered tonight, and you're always free to send me an email with any questions. I hope this has been helpful for you. I hope you've gotten something out of it. Here's my email address. If you do have questions, it's drgary@tradingpsychologyedge.com. Just drop me an email and I'll be happy to address your questions. You can send a chart. I'll be happy to look at a chart. And I will, Erica, I promise you I will have Helen give you a call. Good, Karen, thanks. I'm glad it was helpful, and I hope to see you again in the stuff that we do. This is kind of indicative of what I do and how I go about trying to explain things. I really want you to understand this is not easy stuff, and you really need to work on it. You know, it takes time and practice to get this stuff. I'm asked to define a spring. It is a dip underneath a level of support where the market does not continue to the downside, but instead turns around and rallies back up. We saw a spring somewhere here. Here we go. We saw a spring. We have this level here of support where I have SV for stopping volume. And as we come back down to that level, the market dips underneath, but doesn't continue to go down lower. If this were to have broken, what we would see is something like this, where the market does not close back up above, but instead closes lower and continues to go down, okay, from there. But here, it closes higher and then starts to rally. This is a spring. And they're very nice in uptrends. This is a spring in a little bit of a down move, so you have to be careful with that. But I'm showing you how you can piece it together with this first higher high trade and then capitalize on that. It is still a sign of strength in its own right. For determining shortening of the thrust, do you look at the closes or the high? Tony, good question. I'm looking at both. I'm looking at here we can see, for example, on this chart right over here, we get a little shortening of the thrust here. And it's on the highs that we're getting the shortening of the thrust. We're also getting a clustering of closes in here. And then we get that corrective reaction. This is only a 5-minute chart, so it's not going to do a whole lot. But I'm looking at both of those things. Okay. Sometimes you'll see it in the closes better than you see it in the highs, but it can happen in both. You want to take everything into account. Remember, one of the things I said was that I'm always paying attention to the individual bars and the close and the highs and the lows and the volume. And that's one of the instances where I would be. All right, everybody, thank you very, very much. I really appreciate everybody coming in, and I hope to see you again. And really good trading, and as always, trade mindfully, and say hi to me on the blog or send me an email. And again, thanks for coming in. It's a real honor to teach you this stuff, the stuff that I really love. Okay, everybody, thanks again. Bye-bye now.